What is productivity? It's not what we think in common language. It's about just blocking out distractions and focusing on our work and everything we see on YouTube about productivity hacks. Nah, it's as simple as doing client work. Non-productive time does not exist for clients, jobs, and services, but it does exist for individuals, teams, and at a firm level. A high WIP balance is no use to us. Negative WIP is ideal, so we're invoicing in advance, but what we don't want to have is a WIP balance that keeps drifting up because that's work we've done that we haven't turned into cash yet. The golden rule of practice management is always to align your time and your invoices. What we don't want to have is our revenue completely detached. So my name is McTavish. I'm the CEO and co-founder of Link, which is practice management for high-performance firms. So my goal with these videos is simply to teach you the art of firm management, centered around 5 core principles and how they all play together. There are 5 steps to building a high-performance firm, which I'm going to cover in this video. But who am I? Why am I qualified to tell you these things? So my name is McTavish. I'm the CEO and co-founder of Link, which is practice management for high-performance firms. Now, I've been working with accounting firms for 15 years, and in this time, I've analyzed the data from over 1,000 firms all over the world, which allows me to see what high-performance firms do differently to the ones that get stuck. So my goal with these videos is simply to teach you the art of firm management, centered around 5 core principles and how they all play together. So the 5 steps to building a high-performance firm is, firstly, we want to take control of your work in progress. You want to maintain firm-wide productivity above 55%. Have a laser focus on recoverability, master your pricing, and finally, balance individual workloads with live capacity. So we're going to dive into each of these 5 steps one by one now. All right, so step 1, take control of your work in progress. So work in progress, put really simply, is work done, not yet invoiced. If I am going to do some work for you, let's say my billable rate's $200 per hour and I do 3 hours of work, I would have accumulated $600 of work in progress. That's an asset to me, and I can exchange that work in progress at any point for an invoice to you, which is another asset of mine, which is accounts receivable, and then you'd pay $600 and that becomes cash in my bank, which is another asset. So the first creation of this asset is the work in progress. It's doing the work, and then eventually it becomes cash in my bank, which is another asset. So it just goes through those 3 phases there. Work done, not yet invoiced, is the most simple way of describing work in progress, but it does get a little bit more complex with this because we can have work in progress over multiple clients, multiple jobs, and we can analyze it in so many different perspectives. One of those perspectives is in terms of the period in which we look at that. So there is a formula or an equation for work in progress, which looks at the movements of work in progress within a period. Most commonly, we look at it in a month. The formula or the equation is opening WIP plus our time added plus our disbursements, and disbursements are anything non-time related that accumulate work in progress, such as a contractor's fee, or it could be travel or accommodation, less our invoiced value, because time and disbursements are positive work in progress. They are assets that we've created that we exchange for money. Invoice, on the other hand, reduces it because it's reducing the work in progress to create the other form of asset, which is the invoice. So we reduce work in progress through invoices, and any overs or unders we recognize in net write-ups. And finally, that gives us our closing WIP. So if we do some work and then we don't invoice it within the period we're looking at, it becomes closing WIP, which becomes opening WIP for the next period. So if we look at April 2026, let's say I did $600 of work for you. So 3 hours at $200 an hour, $600. That is my closing work in progress for April as well. Now, in May 2026, that becomes my opening work in progress because I've opened the period up with the $600 that I had closing in April. If I was to do $200 more time, I now have $800 of work in progress because I take the $600 in April, which is my opening WIP for May, plus my $200 gives me closing WIP of $800. All makes sense, right? Great. Now, if I was to invoice $1,000, that's negative work in progress because I'm reducing my work in progress because I'm creating an invoice, which is I'm exchanging one asset for another. And then when you pay that invoice, it becomes cash in my bank, which is the other form of asset. So then what happens is my closing WIP becomes negative $200, which is a bit of a problem, right? I don't want $200 of negative work in progress sitting as closing WIP. Otherwise, when I close all my jobs out, I'm gonna have all these positive and negative WIP figures. And we're also not able to analyze how we've gone on each job because it's all sitting as closing WIP. So what we wanna do is we recognize a write-up or a write-off. So in this situation here, we'd have a $200 write-up. So if we add along these lines now, we have $600 of opening WIP, we add $200, we now got $800, subtract our $1,000, we now have negative 200, and then we add a $200 write-up, we arrive at 0 as our closing WIP. So if you add along these lines, you arrive at your closing WIP balance. This is why it's an equation, and it's infallible. This is science. This is science here for work in progress. Right, so I want to look at another situation. So we saw a write-up. Now let's look at a write-off. So we have the $600 of opening WIP, gives us our 600 in closing WIP. We then add $1,000 of time now, which gives us $1,600 of closing WIP. Now, if we invoice $1,000 like we did in our previous example, we end up having $600 of work in progress. So that's an asset that we have, and we don't want to close our job with that $600 asset on it because that fictitiously inflates the assets or the work in progress in our firm. So instead, we want to recognize a negative 600 write-up, which is a write-off. We've written off $600 of time. So we did $1,600 of time, we invoiced $1,000, and we recognize $600 of that time is written off, giving us 0 as our closing work in progress. All making sense, right? Cool. Now, I'm going to show you another concept here, which is negative WIP. We can have negative WIP. We don't want to close our jobs with negative WIP, but negative WIP is a thing that does exist. So let's say in April 2026, we have $1,000 invoice. That's a deposit invoice. We've done no work though, right? So what happens is we have closing WIP of negative 1,000. Now in May, we do some work. So we have our opening WIP of negative 1,000 because it always flows through to our opening WIP. So it'd be 30th of April, closing WIP would be the 1st of May opening WIP balance. So we've got our negative $1,000 of WIP. Now if we add $700 of time, we can have negative $300, but we don't want to close our job out like this. So what do? We recognize the $300 write up, giving us $0 closing WIP. So I just wanted to highlight this point and show you negative WIP is something that does exist. It rolls from period to period, but whenever we close a job out, we do what's called a WIP wash up, where we take the time and the revenue and we wash them together and we find out what is our over or under. That becomes our net write up, or our write up or our write off, depending how we want to look at it. So that's our first step. We want to take control of our work in progress and really understand it and keep an eye on it and make sure that we're keeping our work in progress as low as we can, because a high WIP balance is no use to us. We'd prefer to have, rather than high WIP, we'd want cash in our bank. So negative WIP is ideal, so we're invoicing in advance, but what we don't want to have is a WIP balance that keeps drifting up, because that's work we've done that we haven't turned into cash yet. So take control of your work in progress. Step 2 is to maintain firm-wide productivity above 55%. Now, why 55%? 55% is the average work in progress of accounting firms. When we look at multiple years over multiple countries, pretty much every average sits between 54 to 56%. So 55% is basically the average productivity of accounting firms. Now, if you're above that, you're a high performance firm. So you want to be above 55%. And that includes administrators' time, right? So if you have a lot of administrators, you're going to find that it's very hard to maintain 55% productivity. So step 2 is to maintain firm-wide productivity above 55%. Now, what is productivity? Great question. Productivity is the ratio of billable time to total time worked. So it's not what we think in common language. It's about just blocking out distractions and focusing on our work and everything we see on YouTube about productivity hacks. Nah, it's as simple as doing client work. So another way to think about productive work or productivity is work that is productive is assigned a billable rate. Simple as that, right? So there's an equation we can use, which is productivity as billable time divided by total time. So billable time is client time, the work that we spend on our client work divided by all the time we've worked. That's productivity. Now, productivity can be measured by an individual, team, or a firm level. So individuals can have productivity. So we look at the amount of client work they've done or the billable work they've done divided by all the work they've done. So there's also meetings and there's training and there's all these other things that they do. That's internal time. So we take the billable amount and divide by all the time they've done. So we can look at it from an individual perspective, from a team perspective, and also at a firm level. And that's where that 55% is that magic number we want to be above if we're a high performance firm. Now, as we've said, you should aim for 55% productivity at a firm level. Now, very, very important here. You should print this off and put it on your wall. If we get our ratio of administrators to billable people wrong, we'll find ourselves in a situation where we don't have enough cash to create more capacity, to bring on new clients, and we find ourselves stuck. And this is the most common reason firms get stuck when they're trying to grow, is they have too many administrators and they become stuck. Let's look at an example of this because it's so important to highlight. We've got a bunch of metrics here, which we'll talk through them in a moment. And we've got our 5 team members. We've got David, who is the partner. We've got Jane, Henry, and Tim, who are our accountants, and then Kate, who's our administrator. Now, David works full-time at a productivity or target productivity of 50%. and his rate is $250 per hour. He generates $200,000 of revenue, costs us $120K. Gross profit on David is $80,000. Now Jane, she's 81% productive, billable rate $150 an hour, bringing in $95,000 of gross profit. Henry, we'll just keep it simple, same numbers here. And Tim, slightly lower productivity, but also has a lower cost rate for us, giving us $100,000 gross profit. Now, Kate's our administrator. So Kate has all of her hours are internal. Productivity 0. She generates no revenue, $80,000 cost for the business. So we have a negative $80,000. But overall, we have a good looking firm here. So we've got 58% productivity firm-wide. So it's above that 55%. So as you'll see, we're looking pretty good here. So we're generating $290,000 of gross profit, less our overheads, let's say $150K, giving us a net profit of $140,000. This is a good looking firm here. This is a good startup firm. Now, next thing is we've got this cash, right? The firm's operating well. So what we're going to do, we're going to hire another team member, James. James is another accountant, 75% productive, $80,000 of profit from James. So let's look at our totals. We are now sitting at 60% productivity firm-wide. This is fantastic. So now we have $370,000 of gross profit, $170K overhead, $200K profit. Really high performance firm here, really looking good. But what happens is Kate cracks. She's been managing everything. Well, everyone's out there making money. She's doing all the new client onboarding. She's doing all of the marketing. She's doing all of the finances, all the administration. She's overwhelmed. She comes to David in tears saying, I can't do this anymore, David. I need some help. I would like help on the marketing side of things and taking over all the work I'm doing, post on social media. And I also need someone to help me with all the finances because I can't keep up these reconciliations. I'm done. And David goes, don't worry, let's sort this out. We've got a lot of profit coming in. So we go and hire Mike. Mike is full-time. And then we hire Sue. Sue is also full-time. So now we've got our ratio to administrators and billable people really wrong here. So let's look at what happens to our productivity firm-wide, 45%. And remember, this is operating at capacity. This is assuming David, Jane, Henry, Tim, and James are all operating at capacity. They're completely full. All of their calendar is booked out with client work. They're working at their target productivity there. 45% is as high as we'll ever see the firm productivity. What happens now? So now if we look at our gross profit, $210,000, our overheads have increased to look after our new team members. We now have negative $10,000 as our net profit. We are now stuck. We are unable to hire our next team member because we don't have the cash, so we can't bring on more clients. This is a firm that's officially stuck. So this is what we want to avoid when we're growing our firm, is to allow our productivity to get below 55% and hire administrators. Basically 50% is that general rule. If you are under 55% productivity, don't hire an administrator because you're never going to be able to climb out of it unless you do a restructure. Right, so step 3, laser focus on recoverability. Now, recoverability is the percentage of work performed that converts into billable revenue after adjusting for write-ons and write-offs. So put more simply, it measures how effectively a firm turns effort into cash. So we have the WIP equation that we're familiar with now. So we've got our opening through to our closing WIP. Now we're looking at it from a team member perspective now. So we looked at it from a job perspective. Now we're looking at our team members. Now to keep this really simple, we've got no opening and closing WIP because it does get more complex once we start bringing in opening and closing WIP. We'll touch on that shortly. But to keep it really simple, let's say that Kate did $27,500 of time in the month, invoiced $23,400, $4,100 in her net write-ups, closing WIP 0. Cool. And then we've got Ted. Ted also had write-offs. This month he had $3,900 in net write-ups. So looking at this, we'd say basically these two team members had the same sort of month. They both didn't perform at where we expected. But when I say laser focus on recoverability, we're not just looking at Ted and Kate here. We want to drill into it. We want to understand, where did these numbers come from? And we'll do that now. So to investigate write-offs, we look to identify patterns versus outliers. And this is such an important concept. Now, if we look at Kate's jobs, she's got her 5 jobs here. The time, you can see her $27,500 that we saw on the other screen. The invoice value. Then we can see her net write-ups. And we can see here a pattern of write-offs. This is showing us that Kate is not performing at the rate we've assigned her. So typically we want to have someone's billable rate 4 times their salary. So if we're paying someone $50 an hour, we'd charge them out at $200 an hour. That's a rule of thumb there. That means that if we're paying her $50 an hour and we're charging her $200 an hour, she actually isn't meeting our expectations to be paid $50 per hour because her write-offs are high on every single job. So this is what we'd call a pattern of write-offs. She's not performing as well as we'd expect for the rate that we're paying her. Let's look at Ted's jobs. Very, very different situation we're going to see here. So Ted is actually performing really well for his rate. So you look at these first 4 jobs, he's actually had write-ups on these jobs, but we've had this massive write-off on job number 5. So this tells us a very different story now. Ted is performing over and above his rate, but something's happened with job 5 that we want to understand. So with job 5, is it because we've said that Ted needs to increase his productivity, so he's gone and put all of his time that would be internal, he just stacked it on job 5 here? Or have we not communicated the budget was $1,200 to Ted and he's put $12,000 of time there? And that's because our workflow system isn't reconciling with the actual budgets. So there's so many things that could be happening here, but what we want to do for Ted is we want to talk to him about job 5 and understand what's going on. With Kate, on the other hand, we want to see, is there any training we can provide her? Is there anything we can do to help her speed up the way she's processing her jobs? So 2 write-offs, very, very similar at face value. When we drill into them, we found one's a pattern and one's an outlier in the data set, and we have very different conversations based on these 2 different situations. So recovered rates allow us to cut through all the noise. Recovered rates are really powerful. So high performance firms look at recovered rates, and we're going to touch on some new concepts here. So the recovered rate is the revenue generated divided by the billable time based on hours. So revenue is a dollar value, billable time is the hours. And from there we can calculate the actual rate we recovered. So if someone's billable rate was $200 per hour, they may have recovered $220 per hour, which means they had a write up on their jobs. So revenue. So what is revenue? Revenue is a new concept now. So revenue is time added plus net write-up. So these are both values from our WIP equation. So the question becomes, why use revenue to calculate recovered rates? Why can't we just use invoiced? Great question. If we look at our WIP formula here, and we have May 2026, let's say that we did $600 of time in this month, but we invoiced $10,000. This was the deposit. So let's say on the 10th of April, we invoiced our deposit of $10,000, and then on the 20th of April, we did $600 of time. So if we're looking for our recovered rate on this job for April 2026, if we were to use invoiced, we'd say, well, there's 3 hours done. There was $10,000 of invoice total. Our recovered rate on this job so far, $3,333. Incorrect. What it is we'd take the $600 plus the net write-ups of 0. We'd say our recovered rate, 600 divided by 3 hours, $200. So we've got our closing WIP, which flows through to May. Let's say we did $11,000 of time here in May, which gives us $600 of closing WIP. But of course, we want to do our WIP wash up once the job's finished, giving us a net write-off. So we're going to have a write-off of $1,600, giving us closing WIP of 0. Now, if we look at May, what was the revenue here? So it's the time added being $11,000 less the $1,600 write-off. And then from there, we can calculate our recovered rate. But if we look at this job as a whole, our revenue reconciles with what was invoiced because we have our $11,600 of time, less our net write-ups being $600, we arrive back at $10,000 of revenue. So why we use revenue is it deals with the flowing of in and out of periods in terms of our work in progress. If we just use invoice, we're not going to get an accurate picture because we've got so much time and so many invoices moving across so many people and so many clients in a firm that trying to use invoice is we're never going to get an accurate picture. But if we use revenue, all it's doing is it's taking the time or the WIP created, the value created, and it's adjusting by those net write-ups once they are recognized. When we look at a period, we're going to get accurate representations of our recovered rates. And that's why we don't use invoice and we use revenue to calculate our recovered rates. Write-ups are indicative of billable rates, which is why recovered rates are so useful. So let's check this out. So we've got Ted, and we've said his billable rate's $200 per hour, right? So we've seen his time added and his net write-ups. Now, we want to focus on time added and net write-ups for our recoverability or for our recovered rates because we understand that invoice is not useful to us. We're just looking at time and net write-ups. Remember, net write-ups are a function of our invoice total. So it's built into the formula, right? So we take our time and our net write-ups, and then we're going to add some new values here. We've got write-up percentage, revenue, hours, and recovered rate. So our write-up percentage on this first job is 50%. So time added was $2,000. We invoiced $3,000, which we saw previously. Net write-ups are $1,000. So our revenue is $3,000. Again, it reconciles back to what was invoiced. All revenue is doing is it's dealing with the flows in and out of periods. Our hours 10 hours on this first job here, so our recovered rate, so $200 per hour is our billable rate, but we had this 50% write-up. Our recovered rate is $300 because we did $3,000 of revenue divided by our 10 hours, giving us a recovered rate of $300 here. Across all of our jobs, Ted's billable rate was $200 per hour, but his recovered rate was $177.95, and that's because he wrote off 11% of his time across these jobs. You can see how all these things are starting to connect now. So if he had net write-ups like he had on these jobs, his recovered rate will be higher on the jobs that he had the write-ups. But when we look at multiple jobs, we find that overall he had a write-off of $2,900, being 11%. That's why his recovered rate is lower than his billable rate. Now, thought experiment here. What we're going to do is we're going to put Ted's billable rate up to $600 per hour, and we want to see how this affects our recovered rates. So the time added is now triple what we saw in the previous screen because his rate is obviously triple to what it was before. Net write-ups have gone through the roof, right? Because we only invoiced what we agreed with the client. Net write-up percentage is high. Our revenue is back where it was. So our revenue reconciles to what was invoiced. The hours haven't changed, so our recovered rates have not changed. And that's what's beautiful about recovered rates, is it cuts through all the noise of our write-offs because it always comes back to the revenue we generated and the time that it took to generate that revenue. So we know revenue is time added plus net write-ups now, and those are the two functions within our WIP equation. And we know recovered rates is revenue divided by billable time, which is hours. We have another one here, which is average hourly rate. So average hourly rate is revenue divided by total time hours. So the difference between these two formulas is the bottom of that equation there. So recovered rates just look at billable time, where average hourly rates look at total time. So it includes that non-productive internal time. So recovered rates are fantastic for clients, jobs, and services, where average hourly rates are great for looking at individuals, teams, and at a firm level. And it's because non-productive time does not exist for clients, jobs, and services, but it does exist for individuals, teams, and at a firm level. So what I often say is you can't escape the average hourly rate. And what's so cool about the average hourly rate is that it's considering both productivity and recoverability in the same formula. So let's look at this again. So we've got Ted's values here. So we've got our time added, net write-ups, all the way through to his recovered rate. Now let's go and look at this. Let's go build this out to find out what Ted's average hourly rate was. So Ted's monthly performance. So we know his billable time, we know his time added, we know his net write-ups, we know his revenue, and we know his recovered rate. So what we're going to include here now is his internal time. So let's say Ted did 28.5 internal hours. He took 8 hours leave. So his total time is 160 hours. So let's say there's 168 hours in the month. 8 hours was leave, giving him total time of 160. So remember, total time excludes leave because leave does not impact productivity. Cool. So productivity is 82%. Now cost is what our cost is for Ted's time, right? So what we want to do is take his salary and divide it by the number of contracted hours to arrive at a rate, and we then multiply that rate by the total time worked, and that way we don't look at leave. So if someone goes on leave, we don't want their ROI to crash. And you could argue that, oh, well, if we look at a longer period, it's going to deal with that leave, it all gets washed out. What happens if someone doesn't take all their leave one year and takes extra leave the following year? Well, then we're going to have a crash of ROI over a 12-month period. So the safest way to do ROI calculations is to do it on an hourly rate basis multiplied by the total time worked. Don't use a fixed monthly cost. Right, so profit. Profit is revenue minus cost, gives us our profit. ROI is 225% for our friend Ted here. So his average hourly rate is going to be the revenue divided by total time, giving us 146.25. So that is our average hourly rate for Ted. Step 4, master your pricing. So there are only 3 ways to bill for your services. There's time and cost, quoted, and subscription. So time and cost is I agree on a rate with you and I do that work and then I send you an invoice. Quoted is I provide a fixed fee for you. Subscription is I'm charging monthly, a bit like a Netflix subscription. So I say the accounting fee is going to be $6,000 for the year. I'll charge you a $500 direct debit or a credit card charge per month. And that way it smooths the cash flow out for the client and also for your firm. Now, there's 3 methods of subscription billing, and this is commonly misunderstood. They just think, oh, if I'm billing on subscription, I'm billing on subscription. But there's actually 3 methods within that. The first one is in advance. The next one is called in period, and the last one is called contract period. And depending on which method you choose has huge impacts on your work in progress and your cash flow in your firm. So we're going to have a quick look at this now. So in advance, what it's doing is we're going to be invoicing upfront for the work we're going to do for our annual financial statements and tax returns. And we're going to bill for any in-period tasks in that period. So I've got my 3 years mapped out here. So what we're doing is we're picking a period. So all your clients, you want to make sure you align with either in advance, in period, or contract period. And then you go, cool, well, it's going to be the start of my financial year. So these are the 12 months of the financial year, and we're sending these 12 invoices to our client. So then what we do is we do our in-period activities, which denoted in blue here. And then our annual accounts and our tax return work is going to be done in the following year. So we're billing up front for the bulk of the work that we're doing. So if we have little bits and pieces throughout the year, we just do it in that year that we're billing. But the bulk of the work is going to be done the year after the year's completed. So for the 2027 financial year, we'd be doing the work in 2028, but the billing occurs in 2027. So when we run this method, we accumulate a large negative WIP balance because we're billing up front. That's cash in our bank, and then we do the work the following year, which reduces our negative WIP balance, and then we do a wash up, recognizing that write up and write off. That's the in advance method. The in period method is we have all of our invoices, just like before, in that period. We do our in-period tasks like we do in the previous one, but the bulk of the work, being the annual accounts and tax returns or annual financial statements, whatever you do, the bulk of that work is done in that period which we're billing. So we end up accumulating negative WIP in months 1, 2, 3, 4, and 5. But in 6, we do a whole lot of work. We get a whole lot of work in progress, and then that's paid off. That balance is then reduced up until that 12th month. So in this situation, we don't run with a huge negative WIP balance because we may end up doing that work in the second month. So we have this huge spike of WIP, and then we pay it off over that time. So this one is a lot easier to sell because you're essentially letting your clients pay off their accounting fees throughout that year, as opposed to the in advance method where they're paying up front for the work, but it is a lot harder to sell that in advance method. So 2 very different methods there. The last one is called contract period, and that's based on when you sign the contract with the client. So let's say they sign on the 5th month of the year. We just roll that out for the 12 months and we just fit the work in at some point within that contract period. So basically when they come to you, we start the subscription and then we just bill from there. The problem with this method is that you need to roll over your jobs annually to do your WIP wash-ups. So we can recognize those write-ons and write-offs for client performance, for team member performance, for firm level performance. And if you're doing those rollovers every single month, it's going to become very highly administrative for your firm, and you have to have more administrators, which is going to drop your productivity. So what we want to do is we want to choose either in period or in advance methods and stick with that and make sure any subscription clients we bring on board, they all go under one of these 2 methods. We stay away from contract period because the administration starts to blow out once you reach 400, 500, 600 clients on these methods here. So pick one based on what you think your firm is best at. If you're very good at selling, go for the in advance method. There's nothing better than having $3 or $4 million of cash in your bank account rather than your client's bank accounts, because that fuels your growth. You can grow very quickly. If you're not so comfortable selling and prefer the easier method, but you still want to move to subscription, choose in period, stay away from contract period. The golden rule of practice management is always to align your time and your invoices, and that's where I talk about rolling your jobs over. So if you're capturing the revenue in that job, so you got those 12 monthly subscription invoices, you make sure the time is going in the same job. So when we do our WIP wash up, we're recognizing that revenue against that time in that job. What we don't want to have is our revenue completely detached from our time. So we've got a job over here, and then a job over here that may have the revenue in it. It becomes very difficult to figure out what your write-ons and write-offs are. So the golden rule is always have your time in the same job as your invoicing. Right, step 5 is to balance your individual workloads with live capacity. So what is capacity? Capacity is the total hours available for client work after accounting for leave and making allowances for internal time. Capacity really is the production plan for your team. So what we're going to do here is look at a capacity plan, or like a back of a napkin capacity plan. And you can do this at any stage, just looking at your team members and looking at some numbers here. So we've got our team members here, Tim through to Frank. Look at the hours per week. So we've got Andrew here who's 20 hours per week. Everyone else is full time. The hours per year. We have our target capacity. So Tim being the partner, 50%. Everyone else is 80%, apart from Vanessa and Frank, who would be our administrators, which is why their target capacity is 0. Got our billable rates in here. Our target billable hours, giving us our expected non-billable hours. You'll notice that both Vanessa and Frank have 1,600 non-billable hours. So from there, we can see our productivity target, which is going to be 52.57%, which is actually under that 55% mark, which is not too good here. Now, what I want to point out here is capacity looks forward. That's our plan. Productivity looks backwards. So capacity looks at what we expect our team members to do in terms of their billable to non-billable ratio. And if someone is working at capacity, meaning they have enough clients to keep them busy for the whole year, their capacity and their productivity, provided they meet their targets, should be identical. So this plan we're looking at right here is assuming our firm is operating at capacity. Cool, so our target revenue, assuming operating at capacity, we've got just under $1.2 million of revenue here. So that's a back of a napkin capacity plan, and you should be able to do that. Now, the assumptions for this capacity plan, if we want to use it as a management tool, this works perfect if no staff leave and you hire no new staff. If everyone hits their exact productivity target every month, if no jobs take longer than expected, no jobs are completed faster than expected, no new work comes in and no clients leave, and finally everyone takes their exact full amount of the entitled leave for the year. So assuming all of these things happen, that capacity plan will hold true for the whole year for you. But in reality, that's not going to happen, right? So what do we want? We want live capacity to make these decisions in our firm. So capacity is the natural byproduct of your workflow. So your workflow system must measure and track capacity in real time. How does this look? So let's look at a visual representation of capacity. So we have allocated internal time, allocated billable time, and available capacity. Those are the three buckets we have, right? So let's say we have our partners, administrators, managers, and accountants, and they'd look something like this. So a partner, if their target capacity is 50%, it means we're giving them a 50% allowance for non-billable or internal work, right? The administrator, all internal. The managers, we've gone 65-35, and our accountants, 80% of the time, we want them focusing on billable activities. So without allocating any work, this is what our capacity plan would look like. We could also view it from an hours perspective. So assuming there's 160 hours in this month, this is the hours available. So the accountants have 128 hours available to take on work. Our partner here, 80 hours available to take on billable work. This reconciles back with that capacity plan that we looked at before with that back of a napkin plan. The beauty of this, if it's built into our workflow system, is this is live and updated with every interaction. So these are available capacities for our team members. But what I want to do here is look at this from the perspective of a real firm. So I want to have our partner, admin, manager, and two accountants here. Let's give them some names, right? So we've got Trish as our partner, Rebecca's our administrator, and we've got David, Simon, and Hannah as our accountants. And I've put our capacity bubbles there to let us know the number of hours we have available. So you're in the business of buying and selling capacity. That's the game, right? So you hire somebody, and when you hire them, you buy their capacity. You buy a number of hours you can then go and on-sell to the market at a margin. So you buy capacity and then you sell that capacity to your clients, and then you're just facilitating the production of the work. So your firm, at a real basic sense, is in the business of buying and selling capacity. So tracking it is probably a good idea, right? So let's look at some events here. So let's say 60 hours of billable work is allocated to Trish. So right now she's got 80 hours of available capacity. So what happens? We allocate her 60 hours of billable work. So that could be one job, or it could be a number of jobs. It could be 10 jobs at 6 hours, or it could be a whole combination, right? So 60 hours of billable work is allocated to her. So she now has 20 hours of available capacity, which I've put in this bubble here. Now, the next event, David, Simon, and Hannah are allocated work for the month. So it may look something like this. And now we can see how much work they've been allocated, and that's their available capacity. So this is what it may look like once we've gone through and done our allocations for the month. Now let's have another event here. So Trish timesheets 10 hours to an internal task. So what's going to happen now is she's got 80 hours allocated for an internal work. When she puts 10 hours of time there, she's only going to have 70 hours now allocated. So we'll reduce her allocated internal time like this, and our chart will adjust. Great. Next, Trish timesheets 20 hours to allocated billable tasks. So when she timesheets 20 hours to allocated billable work, she's gone from 60 hours of allocated billable work down to 40 hours allocated billable work. So would reduce the size of her blue bar like that. Cool. Her available capacity has not changed because the time she did was on her allocated work. Now, Trish timesheets 10 hours to an allocated billable task without any remaining budget. So it's a task she's been allocated, but let's say it was a 20-hour task and she's already put 20 hours to it. And in that situation, the actual allocation is 0. So if she goes and puts another 10 hours to that task, she's put 30 hours in total to that task. That's not in our blue bar. That doesn't exist because we had 20, she spent 20, remaining is 0. So therefore, when she puts 10 hours here, it's going to have to come from somewhere. Where does it come from? Her available capacity. So we reduce that. Now she's got 10 hours of available capacity. So all of these interactions are keeping our capacity live. So the next event, Trish timesheets 10 hours to a leave task. So leave, remember, Trish, her target capacity is 50%. So that means that if she's going on leave, that time is no longer available to the business. Therefore, we want to reduce 5 hours of her allocated internal, and 5 hours needs to come from the other side, which is the billable portion. But we haven't changed the amount of work she's been allocated, so she's going to lose 5 hours of available capacity. So we reduce those two, like that. and then she will have now 5 hours of available capacity. Let's look at this last event here. So Trish timesheets 10 hours to an unallocated billable task. So it's billable work, it's productive work, it's client work, but it's not on her list. So it's not going to come from the blue. It's going to come from somewhere else, which is her available capacity. So she's only got 5 hours available and she's done a 10-hour timesheet. So what do we do here? We need to show that she's over allocated like that. So then she's going to show -5 of available capacity, which means she's 5 hours over allocated. And this is the sort of thing we want to keep an eye on as we're working. Our team members are going to work on tasks they're not allocated to. They're going to go over budget on tasks. We're going to allocate them tasks they don't have enough capacity for. And we want to keep an eye on over allocation for our team members. Otherwise, work tends to gravitate towards our best people. We over allocate them. When we don't have visibility into this, what happens is we do this month in, month out, month in, month out, and our best team members get super stressed. They take that work home, they work extra hours, and eventually they crack and they leave. And then rather than trying to hire to grow our firm to create more capacity for us, we end up having to replace our top team members that take so much of that valuable knowledge, all those client relationships and all the things they know about their clients, that disappears out of our firm. Now we're trying to hire to replace them rather than worrying about the growth of our firm. So having access to live capacity allows us to see in real time how much work each team member is allocated, and we can keep tabs on which team members are getting stressed based on over allocations. Because if they're over allocated, they're likely to miss deadlines, and that creates more and more pressure on them. So growing a firm is a game of hiring to create capacity and then bringing on clients to fill that capacity. That's the game. We create capacity by hiring, we fill it with more clients, we then have excess cash that affords us to be able to hire to create more capacity. That's the game of growing a high-performance firm. So insight into live capacity allows you to balance workloads and grow your firm with confidence. So if we're not balancing our workloads, it's going to gravitate to our best people. They crack, they leave, and we're trying to replace rather than to hire to create more capacity to grow the firm. So those are the 5 steps of growing a high-performance firm. If you are looking at growing a high-performance firm, or if you're in the process of doing it right now, consider subscribing to the channel, and I'd love to know in the comments which part of this video you found most useful. So let us know in the comments there, and I hope your firm is doing awesome, and I'll see you in the next video.